Well, our next guest says don't chase tech here. Let's bring in Dan Suzuki, the portfolio strategist with Richard Bernstein Advisors. You would have said this on Friday, too, right? It's not just today after the pop that we've had in technology. Why? Why not?
Yeah, that's right. I think, the most important thing that we key on at RBA is the fact that growth is slowing, right? And everybody thinks about, you were just talking about how tech is considered this high growth name. You got to go there when there's nothing else. But actually, if you look at the underlying data, actually one of the nerdiest reports I ever wrote at my prior firm was looking at how all the sectors and subsectors of the S&P, how their earnings are correlated with 150 different macro factors. And what the interesting thing was that tech earnings were more cyclical than any other sector, including, when you look at manufacturing or industrials, it was more tied to like the ISM or more correlated with the ISM than that. And the work that we've done at RBA also reaffirms that. So if growth is slowing, that's going to hurt the cyclical stocks, and tech is one of the most cyclical stocks that people don't really realize. So if that's the case at RBA, rather than buy, the cyclicals, we actually think you should focus more on stable growth and quality, which are actually trading very cheap today. They're kind of out of favor. So I think that's the place to concentrate. Now, there are things to like about technology. One of the concerns that people have for the cycle is credit. They're the only sector in the S&P that has net cash on their balance sheets, so they're fine from that perspective. But I think, the bottom line, if their earnings start to roll over, which you've already started to see signs of, I think that's going to be reflected in the stock.
So there had been some argument that technology was somewhat defensive because of the cash on the balance sheet, because companies still have to spend to increase productivity in an environment like this, because they pay dividends now at this point. In your view, though, what is the most defensive sector, if not technology?
I think right now the sectors that are defensive that we like the most are healthcare and staples. Healthcare, if you look at the underlying fundamentals, while tech is actually rolling over, healthcare fundamentals are actually gaining momentum right now. So yes, some would say that healthcare is crowded, but I think the fact that valuations are good, fundamentals are very good. I think that there's no other sector that has better beat percentages in their earnings than healthcare does. So what you want from a stock is a stock or a sector that's going to beat expectations, and healthcare continues to do that. Staples is completely out of favor. I think that if you look at fund positioning, it's pretty close to a record low, and that's a sector that has stable growth. And I think that's what you want to key in right now, given that growth is slowing. So I think those are the two. But even going beyond sectors, I think the biggest theme that goes across our portfolios is higher quality. So it doesn't have to be healthcare and staples, but if you find companies that have strong balance sheets, stable earnings, and that's the type of company I think you want to own.
Let me just push back a little on the staples. So when you talk about growth there versus growth in technology, I mean, that's got to be a substantially more subdued number.
Sure.
At multiples that are maybe market-ish multiples.
Yeah, I think that's a fair point, but I think when we look at it, it's all about relative growth, right? So if you look at the growth of technology, which is way up here, it's starting to slow. Whereas staples growth is here and it's not really moving that much. If you look at that relative growth, you just track one divided by the other over time, I'd say that those numbers are actually getting more attractive, despite the fact that from an absolute level, technology's growth is better. I think a lot of that's priced in.
Outside the United States, the last time I spoke to you was, I think, the beginning of February, and you liked China.
Yeah.
Do you still like China after the run that we've seen?
I do. I think what we're looking at today in today's world is, everybody was talking a couple of years ago about global synchronized growth. We're in a global synchronized slowdown, right? And so in that environment, you're looking for anything that's bucking the trend. And I think China is bucking the trends on all fronts. I mean, we look at profits, liquidity, and sentiment. I think sentiment for China clearly is improving, but it's still at the epicenter of people's concerns around trade, global slowdown, and credit. So people still don't want to own China. Liquidity, they're literally the only major economy out there in the world that's pumping liquidity into their economy. Everyone, in some form or another, is either slowing their easing or they're outright tightening, right? So they're bucking the trend from that perspective. And then from a stimulus perspective, they're clearly the ones that are accelerating their stimulus by everyone and off. A lot of people don't realize that global growth is slowing this year, and we have all these articles today about global growth expectations are basically the lowest since the recession. A big driver of that is just that governments are spending less this year. They had a big couple of spending years, and they're easing off the gas pedal. That's probably the number one driver of the fact that growth is slowing today, and I think that that's the opposite of what China is doing. So I think that is very encouraging to us. Now, clearly the data coming out of China is getting worse and worse, but the forward-looking indicators that we're looking at, there's a lot more green shoots there. So I think from a risk-reward perspective, it looks very attractive, but I wouldn't say, you back up the truck just yet, but I think it's worth an overweight for sure.
Dan, good to see you. Thank you for coming
Thanks,
by.
guys.
Dan Suzuki, Richard Bernstein Advisors. What do you like that Dan said? Or maybe
Well,
nothing.
what I like, I mean, so again, it goes back to, he's talking about tech in general. And I agree with Dan. If we get a global slowdown, tech in general, not just Facebook and Apple and some of those idiosyncratic things, but you get a global slowdown, you get a stronger dollar, you get stuff like that, that's going to hurt tech in general. And that's why, in general, I am more bearish than I was 2 weeks ago, right? I think that we haven't priced in all these problems yet, and tech will be at the forefront of it.
I look at big cap tech, and you still have the best PEG ratio, so the price to earnings growth, and I don't think that's disputable. Dan makes great points. I do think that staples, to me, look really expensive. I mean, some of the names he mentioned, great, but Colgate, Procter & Gamble, Coke, Pepsi, you name it, that's defensive. That's also really expensive here. I don't see a lot of defense there.